If you had invested 1 lakh rupees in an average performing equity mutual fund 3 months ago, your money would have gone down to 92,000 as of today. All the equity mutual fund categories have on an average fallen down in the last 3 months. If you look at the last 6 months data, the situation seems gloomy with most of the equity categories of mutual funds showing negative returns on an average. Well, this is happening as the stock market is facing a downturn. The popular benchmark stock index that tracks the largest 50 companies of the country, Nifty 50 index, is down by roughly around 8% in the last 3 months. From its high in September, the Nifty 50 index has fallen down by 12%. But why are stock markets going down? Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. So in today's video, we are going to discuss the reason of turmoil in the stock market. We'll also answer the most common questions being asked by most of the new investors. What should they do now with their mutual fund investments? Is it time to stop their SIPs and move to conventional fixed deposits, or should they continue with their investments? So very quickly, let's answer the concerns. But before that, let's understand why exactly are the stock markets falling, dragging down your mutual fund returns. So there are several global and domestic factors as well as valuation concerns that have led to nosediving stock markets. Number one, US Fed's interest rate policy. Strong economic data in the United States has reduced hopes for interest rate cuts by US Federal Reserve. Now, without getting into details here, so this move strengthens the dollar and weakens the rupee, making Indian markets less attractive to foreign investors. Number two, heavy selling by foreign investors. Foreign investors and domestic investors are two key players in the Indian stock market, and foreign investors have been withdrawing large amounts from the Indian stock markets recently. So far in January, the FPIs have sold stakes worth 40,055 crore rupees. They were in fact net sellers in index futures, and stock options as well. Number three, rising oil prices. Crude oil prices recently hit a 3-month high with Brent crude trading above $80 per barrel. Since India imports most of its oil, higher prices increase costs for businesses and consumers. Coming to slowing economic growth of our country. The Reserve Bank of India's move to bring down the annual GDP projection for the year to 6.6%, down from an earlier projection of 7% in the economic survey. So growth in GDP in simple terms would mean that the economy is growing in size. It is getting bigger in terms of value of goods and services and vice versa. Then there could be valuation concerns. Now valuation means what is the value of a particular stock? Is it fairly priced or underpriced or overpriced? So after a big rally last year, stock valuations became very high. For example, the Nifty 50 reached a price to earnings ratio of over 24x. These high valuations are not supported by actual earnings. Thus, this contributed to correction in the stock market as well. Okay. Coming to the investor concerns now. So, should you stop your investments via systematic investment plan? Let's start with what happens if you stop your SIP. So, when you invest your money, you are basically putting your money to work and earn more money in form of returns for you. Now, over time, you start earning money of these returns as well. This is known as compounding. And when you skip an SIP installment, you hamper the whole process, which hits your finances really badly. Suppose you started a 15,000 monthly SIP in an equity fund for 20 years. Now, assuming a rate of return of 12%, you would have made a corpus of 1.5 crore after 20 years. But if you had skipped only one SIP every year in this 20-year period, that means you invested 2.8 lakh lesser during these 20 years. Your total corpus would have fallen by almost 40 lakh to 1.1 crore. Seems sinful, right? Next, let's look at what happens if you try to time the market. That is, if you invest only on the best days of the market. White Oak Capital Mutual Funds did wonderful research and the results were amazing. Look at these 3 cases of investing via SIPs between September 1996 and October 2024. Long enough period, right? So number 1, if you had invested on the worst day every month. Number 2, if you had invested on the best day of the month every year. And number 3 is the most disciplined one. Regardless of market ups and downs, invested via SIPs on a fixed date, say 15th of every month. Look at the difference in their long-term returns on SIP investment. You can see there is hardly any difference. So I hope you have got your answer. It does not make sense to stop your SIP in mutual funds. In fact, Radhika Gupta, Managing Director and CEO of Edelweiss Mutual Fund, advises that there is a natural temptation to panic and take action when the stock markets are going through rough times. That may not be good for your portfolio. For those tempted to hold their SIPs or switch to perceived safety of fixed deposits, well, let SIPs continue because now you are buying units at a cheaper level. So instead of trying to time the market, give time to your investments. See the table on your screens. Now listen to this carefully. If a person invests for a year, the chances of losing money are approximately 17%. But if he remains invested for more than 5 years, the likelihood of losing money falls to zero. So you can see how the likelihood of losing money decreases as your investment period increases, and the probability of getting good returns increases as well. So to sum it up, well, markets go through up and downs. This is completely normal and has been happening for decades. Remember, long-term investing works. If you have invested in consistently good performing mutual funds for a 7-year or a higher horizon, short-term dips should not bother you. And well, to get some help on best mutual funds, you may explore the playlist on our channel Best Mutual Funds 2025. And if you want to invest in mutual funds, you can do that on the ET Money app by paying 0% commission for absolutely free. Thanks for watching, and I'll see you in the next video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.